You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Ken Keating, a 25-year options veteran with roles ranging from market maker and risk and portfolio manager, among others, as well as a fellow options instructor here at OIC. Ken, welcome back.
Thank you, Mark. Glad to be here and happy 2023.
No, you too. Thank you. So, Ken, as you know, last month I presented 2 webinars introducing investors to options. We talked about the rights and obligations of buyers and sellers, differences between calls and puts, etc. But what we didn't get into were pricing options and how they're valued, some of the various pricing components, how changes in demand affect pricing, etc. And seeing as how you'll be covering these concepts and a whole lot more in your 2 upcoming webinars for OIC, I was hoping you can give us a sneak peek of what you'll be talking about. Sound good?
Sounds good. Absolutely.
All right, good. Let's start at the beginning then. Can you explain to our listeners how options pricing is determined? Meaning, who determines how much an option is worth, what price an investor is able to buy or sell specific options? How does that options pricing universe, what does that look like?
Absolutely. So anytime you pull up any given stock, you pull up your options chain and you're going to see various strikes, you're going to see various prices, they're going to be moving, you're going to see bids and offers and all these flashing colors and numbers. All these prices that you're seeing are not random, okay? Anytime you're looking at an options chain, what you're looking at is the aggregated market's assumption of the value of that option at any given time. And the value of any option is really going to be determined by the supply and demand for those options. So those prices that you see aren't random, okay? They are based on the supply and demand for options. So typically when you see a market that's $1 bid at 120. Okay, maybe it's 100 up, meaning there's 100 on the bid and there's 100 on the offer.
So in other words, right now, you could sell 100 contracts for $1, and at the same time, you could buy 100 contracts for $1.20 per contract.
So that's known as the bid-ask spread. And the people that make up the bid and the offer, those could be market makers, professional traders, that could be individual investors, such as yourselves. It could be pension funds, hedge funds, banks, anybody who's participating in that market at any given time. So it's really the price at any given time, and it's always changing, is going to be based on the forces of supply and demand.
Okay, so the pricing is determined by all market participants, whether it be, as you had mentioned, a professional market maker standing there on the trading floor or behind their wall of trading screens. It could be a hedge fund, a Wall Street bank, or it could be somebody like you or me. If the market is one bid at 120, like you said, and me as an individual investor, I decide that I want to pay 105 for that contract. I enter my order, and now that 105 bid that I have entered is disseminated to the investing world, which is a kind of a neat thing that I always thought when it came to placing bids and offers, that my best bid could be reflected ahead of, say, a Wall Street bank who is only looking to pay $1. If I'm willing to pay $1.05, then the market is going to be aware that I'm the best bid out there. So I always thought that was kind of neat. So pricing comes from all market participants. Let's talk about how those prices are determined. Where do I get that 105 bid from? Do I, obviously I don't arbitrarily pick it out of the air. Let's get into pricing models and different inputs that go into those models. What can you tell us about that?
Sure. So pricing models are essentially tools that traders use to come up with a theoretical value for their options price at any given time. So just like any model, there are inputs and outputs. So for an options pricing model, the inputs are the strike price of your option, the stock price at any given time, the implied volatility, we'll get into that in a little bit, any dividends and interest rates that are part of that security, and the time remaining to expiration. So when you put all that into this model, that's your input. Your output is going to be what is known as a theoretical value. So you put in all these, going back to our previous example, if the market is $1 bid at 120, right in the middle, $1.10, that's considered fair value. So if you put in all your inputs into this model, it might come up with a fair value for this option being 110. So as a market maker, they said, okay, well, if it's worth 110, then theoretically I can buy it for $1 or I can sell it for 120. Either way, I make 10 cents. That's the bid-ask spread. So that's what's known as a theoretical value. Is that the right price for the option? Well, that's yet to be seen because option prices are very fluid and they change all the time. But at that given time, the market's saying fair value for that option is 110, and most participants are using some kind of a pricing model to determine that value.
Okay, so that value of 110, you're talking about a market maker might be able to purchase it for $1 or sell it for 120, and therefore they theoretically make a dime. For market makers, that's what they call edge. And as you know, market makers, they trade for edge. That's how they that's how they make their money. Individual investors aren't trading for edge; they're trading directionally, meaning, or I should say, in most cases, they're trading directionally, meaning that they're bullish and they think the stock's going to go up, or they're bearish, they think it's going to go down. They're looking to establish a position, typically over the long run, and whether that long run is 15 days or 30 days or 2 years, as opposed to a market maker who's looking to establish that position likely for minutes. They capture that edge and then they trade out of it and they move on to the next trade. And the reason I bring that up when you had mentioned fair value is, to me, that's the difference between individual investors and professional traders. Professional traders, they don't care if they're buying or selling. They don't care if they're trading puts, calls, spreads, what have you. All they want is to capture that edge, move out of the trade, and move on to the next one. Whereas an individual investor is looking to establish position. They're looking to profit on their forecast, their opinion, their motivation, their objective, what have you. Do you agree with that? Does that make sense?
Absolutely. So, like just let's just say you're a retail investor and I'm a market maker, and you think that this option is a good purchase at $1.20. Well, maybe you buy 10 contracts, and obviously you're bullish. They're calls, and you want the security to go up, so your calls take on more value. Me, from my perspective as a market maker, I don't have an opinion on the stock, whether it goes up or down. I'm just
right. You don't care.
I don't care, right? So I'll sell you the calls at 120. I'll go hedge it either with stock or other options, and I have no opinion on the stock. You got an opinion because you bought the calls. You're directionally bullish. Me, on the other hand, I'm just trading for edge. I just lock that 10 cents in, and hopefully that theoretical profit goes into my pocket. Now, that doesn't always work out because theoretically it's a theoretical value. So, market makers are trading their bid-ask spread all day, and they're building this mountain of theoretical edge, which in theory comes in, which is in theory their profit, but it doesn't always work out that way. Market makers lose money too. So, it's as I can tell you firsthand. Yes.
Right. No, I'm sure. So let's get back into the models for a second. You were talking about the inputs, those being stock price and strike price, days to expiration, interest rates, dividends, and of course implied volatility, which we'll get into a second. Those components, the first two, stock price and strike price, those are the intrinsic value of the option. So those are the inherent value of that contract. If I've got stock at $55 and I have a $50 call, that $50 strike call gives me the right, but not the obligation, to purchase stock at $50. And if stock is trading $55, intrinsically, that call has to be worth at least $5 because that's the difference between the strike price and the stock price. The other components that you had mentioned, again, days to expiration, interest rates, dividends, implied volatility, that is the extrinsic value. And those two components, the intrinsic and extrinsic, that makes up our option price. Those are the components that go into it. So the difference between intrinsic and extrinsic is simply intrinsic is the inherent value of the option, difference between strike and stock price. Extrinsic value is going to be everything else. And of those everything else, would you agree that implied volatility is probably the most important or one of the stronger influences on the price of a stock? Or I'm sorry, the price of an option.
Absolutely. I would agree with that. And I always tell people this, that, understanding implied volatility, it's really the most misunderstood but crucial aspect of trading options. So anybody who's looking to trade options really needs to have an understanding of implied volatility and how it can affect their options position. So as you were referring to earlier, where an option has both intrinsic and extrinsic value. Now, an option, has a finite life. So let's just say we have an option that is a week to go to expiration. Using the same example, stocks trading for 55, and I buy the 50 call. Intrinsically, it's got $5 of intrinsic value. Maybe with a week to go, it has 25 cents a time premium. Okay. As we get closer and closer to expiration, that time premium erodes. When at expiration, that option is either in the money or it's out of the money. Okay, there's only two outcomes. So
right, and that time premium that you're talking about is the extrinsic value.
Right, and that extrinsic value is comprised of time It's comprised of interest rates and dividends, as well as implied volatility. And because implied volatility is constantly changing with the supply and demand for options, that value can increase or decrease based on the supply and demand for options. So it's implied volatility, and I know we're going to get into this in a little bit, but it's the one component that market makers or traders, anybody who's trading options, is trying to solve for, and it's not a fixed target. It's constantly changing. So it's a very fluid component, and it is, once again, based on the supply and demand for options in that particular product.
Okay, so let's get into volatility now. Let's start out with volatility that in and of itself is simply talking about market turbulence, for example, meaning that the stock price might go up or down, but volatility in and of itself is non-directional, right? We're not saying that if volatility increases for the underlying stock, that the underlying stock price is going to increase. What we're simply saying is that the range of prices within a specific time period, we expect to be to have larger swings, for example, than a stock with lower volatility. So a higher volatility stock may have larger swings in pricing. Let's say the stock is trading $55. If it's got a high volatility, maybe that next day stock might be trading between 50 and 60. It still has that $50 core price, but the range of future trading might be wider, as opposed to a low volatility stock where that range might be $53 to say 57, something like that. So let's talk about volatility. Let's talk about the differences. Let's start with historical volatility, if you don't mind, and then we'll get into implied. So what is historical volatility, and how can option traders make use of that?
Okay, sure. There's historical volatility, implied volatility. Let's start with just historical volatility. Historical volatility is essentially, it's a backward-looking measure that's really telling you how volatile stock has been over a given period in the past. So
right, so like a rear view mirror look at where the stock has been over a certain period of time.
Exactly. So if we're looking at a 1-year chart of XYZ, and maybe XYZ is a software stock, it's probably been pretty volatile, both up and down over the last year, whereas say a utility stock or maybe a bank stock is going to be less volatile just because it doesn't have as much movement. Stocks, they all have, just like people, they have their own personalities, and some move more than others, really. So, and based on that, the historical volatility of the security is a backward-looking metric. It's just telling you how volatile it has been in the past.
So that's historic volatility, where the stock has been, the range of trading over a specific period of time. And then we've got implied volatility. How does that work?
So as historical volatility is a backward-looking measurement, implied volatility, on the other hand, is a forward-looking measurement. And implied volatility is trying to, it's the market's idea of how volatile that stock will be between today and its expiration. So as we were referring to earlier about option prices are based on the supply and demand for options, as options traders bid up the price of options, in other words, going back to our previous example where the market's $1 bid at 120, and I buy a bunch of calls for 120, maybe a huge order comes in to buy them at 120, now the market's offered at 130, and I buy those. Now the market's offered at 140, and the stock's in the same spot. What's changed? What's changed is the market's willing to pay more and more for that same option with the stock in the same place. In other words, the market's expecting a greater volatility or expected movement, whether that's up or down. It's not directional. It's just movement, either up or down. The market's anticipating more volatility or more movement for that security, and that's why the price of the option goes higher.
Right. So as the demand increases, and just like any other good and service, as demand increases, pricing increases as well. So even though the stock price hasn't changed, If the stock price hasn't changed, days to expiration hasn't changed, strike price hasn't changed, interest rates, dividends, remember, those are all the components that we had said go into that pricing algorithm. If none of those change, and yet the option price does, the only possible explanation is that implied volatility is increasing. As you had mentioned, that's a direct function of demand. One thing I want to clarify or ask is, you had mentioned that the implied volatility, let's say hypothetically implied volatility is 30%. That 30%, is that representing, and let's say my option contract is for 45 days. So does that 30% mean that the market is saying that my option contract, that the implied volatility or the volatility for the underlying stock is expected to be 30% over the next 45 days, or is it 30% over the next year? And then I need to figure out what that actual volatility would be for that 45 days.
Right. So volatility is based on an annualized number. So let's take a simple example. Stock is trading for 100, and let's just say the at-the-money calls we're looking at, the 100-level calls are trading at a 30 vol, and they've got 45 days to go to expiration. What that means is over the next year, it's anticipated that that stock is going to be either up or down by 30% or one standard deviation. So either trading at 130, between 130 and 70 over the next year. And that's all fine and good if you're looking, that's over a yearly period. But if we're trading a 45-day option, okay, what does that mean for a 45-day option? So that's when you actually have to break down that volatility, that annualized number, into a shorter time period, which we'll look at during my webinar, because there is a formula for that. But volatility, it's essentially it's based on an annualized number, but you have to convert that number into a shorter dated time frame if you're looking at, let's say, a 1 day. If you want to figure out what the 1 day expected move is, the weekly expected move, the monthly, there's a formula for that. So, volatility is based on the square root of time and not time itself. I know that it's kind of, that sounds like a lot, but it's
right.
based on
and it's options. So obviously, math is going to be involved. We'll have to take pen to paper and figure some things out. But this is something that I know that you'll address in your upcoming webinar, that rule of 16 that I think you're alluding to figure out the implied volatility for that particular time that we're looking for the option. So, Ken, awesome information. Thank you so much for joining me today and letting me pick your brain about option pricing. Believe me, we're certainly looking forward to your upcoming presentation, as I'm sure that you're going to be taking a deeper dive about what we had spoken about today and several things that we haven't covered. One of the good things about OIC doing a new format of 2 webinars per month is it's going to allow us, and in particularly you, more time to really delve into the weeds about specific subjects, in your case, pricing. So we're very much looking forward to seeing that. Listeners, you can register for Ken's upcoming webinars via the events section on our OIC website, www.optionseducation.org. And Ken, again, thank you so much for joining me. Really appreciate this.
Absolutely. Happy to be here, Mark, and I look forward to next month and the presentations.
No, excellent. And listeners, thank you so much for joining us today. As always, please feel free to send your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.